What type of financings are available today when you're buying your first home? For that question, we've got the man, Peter Carlin from Cross Country, when we're going to break it down without the pros and cons of FHA, conventional, stated income. We've got the Sonny Mae special, our favorite. We're going to talk about hard money and stated income. Let's do it. Thank you very much, guys, coming back to our channel with our special guest, Peter Carlin. Tell us about yourself.
So my name is Peter Carlin. I've been with Cross Country Mortgage for a little over a year. I've been in the mortgage industry since 2013. Been in the financial industry for about 20 some odd years. Former actor. And
that's why you're here, brother.
Well, I'm here for the mortgage part.
Perfect. Peter, let's start with pros and cons about FHA first.
Okay, so FHA loan, Federal Housing Administration.
Got it.
It's a wonderful loan, right? Each one of these loans serves its own purpose, right?
Perfect.
So the FHA loan is a great first-time home buyer program. You can put down as little as 3.5% for a single or multifamily home.
So that's major. So is it the only loan that you can put down such a low down payment, 3.5%? Is it one of the pros?
No. Well, Sonny Mae allows you to put down there are conventional loans that you can put down 3% on single families. And Sonny Mae allows you to put down 3% on single
So if you look at the FHA, if we stick to the FHA, what are the pros and the cons for who would be the ideal buyer for the FHA?
So the ideal buyer for the FHA is someone who's got needs a little more latitude or a little more flexibility on their income requirements.
Got it.
And someone who may have a lower credit score, right? Because we can qualify someone for as low as 580.
So that's the huge pro.
That's huge.
So you can buy a home with as low as
580 credit score.
So 580.
And by the way, let me just stop you for a second. I apologize. So when I talk about credit, we're talking about a mid score, right? The three credit bureaus, TransUnion, Equifax, Experian. So what we're talking about is the middle score
out of the three.
Yes.
Got it. And if it's 580, bang, you can go ahead and FHA.
Yeah.
Perfect. The cons?
The cons, well, it comes with mortgage insurance. A lot of you know and you've heard about this thing called mortgage insurance, right?
And it's expensive.
And it can be expensive, yes, indeed. And with an FHA loan, you have two types of mortgage insurance. You have an upfront mortgage insurance, and then you have a monthly mortgage insurance.
So the upfront, that's a part of your closing costs.
Well, so here's the interesting, that is correct, 100%. So one of the things about that is the FHA allows borrowers to roll that part of your closing costs. Normally closing costs for a purchase, you cannot roll into the loan.
Got it.
Right? But the FHA allows borrowers to roll the upfront mortgage insurance into the loan.
What is it, like a percentage of the loan amount, or?
Exactly right. He knew it. 1.75% of the loan amount.
So that's a lot of money, though.
It's a big chunk if you take 1.75% of the loan.
So that's definitely like con, right? So the pro, super low credit score allowed.
Right.
But the con, you're gonna have this high upfront mortgage insurance that's gonna be rolled into the into the loan amount.
Into the loan.
So then what happens is actually increases your monthly payment.
So now you have monthly mortgage insurance. By the way, let me take a step back if I can quickly explain mortgage insurance.
Yeah.
So mortgage insurance is an insurance that a borrower pays if they put down less than 20% on their down payment. Why are they paying it? Well, you're paying it because you're basically giving insurance to cover the lender in the event that you default, right? So the government established 20% as a cushion.
Just like a safety net.
It's a safety net. It's a safety net, right?
Gotcha.
So that's what it's there for. So the monthly mortgage insurance premium for an FHA loan can be quite high, and it doesn't go away. Here's the big downside.
So that's the big downside.
It does not go away for the life of the loan unless there's an unless you put down 10% or more. If you put down 10% or more on an FHA loan, then the mortgage insurance will go away after the 11th year. That's how it works. But that's a long time to pay mortgage insurance. So the only reason I would put somebody into an FHA loan or suggest an FHA loan.
So this is the ideal buyer. So who would be the ideal buyer borrower for FHA would be?
The ideal borrower would be somebody whose credit score is not so great and or someone who's got, they need a little spread, a little latitude on qualifying with their income requirements. And they
elaborate on that because it's a little confusing. So basically, it's the debt to income ratio, right?
Right.
So you can have a little more debt versus your income. So the debt to income ratio is higher.
That is correct. And this is a great.
So you can basically qualify for a little bigger home.
That is correct. That's correct. With less income. That's correct. What Roger just said is really, really important, everybody. So debt to income ratio, we call it DTI in the business, right? Debt to income. That is one of the main things.
That's the thing.
Well, it's not the thing, because we look at credit, we look at your money, right? We look at assets. We want to make sure that you have the money for the down payment and for the closing costs, and we want to make sure that you have the credit. But one of the biggest things is the debt to income ratio, right? Debt to income. We want to make sure that you have enough income to cover your debt, and it's the debt of your monthly mortgage, your proposed monthly mortgage payment, plus the credit debt that you have on your credit report that we see on the credit report, and or it could also be like alimony, child support, stuff like that. We also
and we broke it down in one of the previous videos we shot it with Anthony behind the camera. We discussed the debt to income ratio and the affordability length.
Yeah.
So you can go through that video and see exactly how the debt to income ratio works. So anything else about the FHA, or you think that's pretty much it?
I think that's pretty much. Here's where it's really great, and I've seen people
taking advantage of
take real advantage. I've had clients just recently. I'll give you an example. 3 sisters. Okay, they made about $20,000 each, and they put down 3.5%.
$20,000.
$20,000 each. They put down 3.5%. And they bought a beautiful two-family home in New York City, in the Bronx, for about, I think it's about $700,000. Incredible.
Now, one more thing I just remembered, first-time home buyers only, correct? The FHA?
Actually not. There
change
are, well, so normally yes, but there are reasons that you can get a second FHA loan. For instance, if you're moving 100 miles away from your current
so it has to be 100
home,
miles.
100 miles, it's a 100-mile rule from where you currently are, and it's because you're moving closer to where a job is, right?
Mm-hmm.
Right, to where it's got to make sense. The other reason is that your family size has increased.
Wow.
Right, so you've had children, and where you currently are is just it's not big enough, and so those 2 reasons. There may be others. I'm not sure. Please forgive me, but those 2 are the things that I know that you can have a second FHA loan. Yes.
Got it. I didn't know that.
Yeah.
Perfect. You see, you always learn, right? Bottom line. So now, since we had covered pretty extensively the FHA, let's talk about conventional.
Okay.
Right? The pros, the cons, the ideal buyer / borrower for conventional.
Okay. So a conventional loan is a loan or a mortgage that is not backed or secured or offered by a government agency, such as the FHA, USDA, the VA. And these loans are typically, first of all, you have to, your credit score minimum is 620.
So much higher than the FHA.
Yep. And the income qualifications are a little more stricter. So the debt to income ratio are less than the FHA. Right? They're less than the FHA. Now, with the conventional loan,
Can you give us an example, like the debt to income ratio on the conventional versus the FHA? Is it a big difference?
Yes, sir. I'm going to give you numbers, right? And maybe in a future video or something like that, we can break it down. But on an FHA loan, I can do, like, there's a front end, something called a front end ratio and a back end ratio.
I learned it yesterday.
Do you want to tell them what?
No, go ahead.
He knows. Okay, quickly. When we're talking about income and we're talking about someone who's self-employed, we use the net, we go with the net income. And there are some deductions and add backs and stuff like that, but we go with the net, right? So the net is the difference between the gross and the net. Gross income is your money before taxes, and your net income is we take all these deductions and then we end up with a net number, right? Most self-employed people, if you're one of them, you know what you do. You take your big gross sales and you take all these wonderful deductions and you end up with a low net number. right?
But you as a bank, you look at the net.
We as the bank, we look at the net. And there are add backs such as depreciation, but we go to the net. Now, if you're a W-2 employee, we are looking specifically at your gross. We don't look at the before taxes, we look at the gross income. So these are two very important things. So let me go back to, we were talking about debt
The
to
debt to
income
income
ratio.
ratio, what's the difference on the conventional versus the FHA?
Right.
Just the percentage.
So percentage on an FHA front end, and that's where I was talking about before. The front end is the mortgage payment divided by the income. Again, for self-employed, the net. For W-2, the gross.
And mortgage payment, you mean the PITI, the principal, interest, tax, and insurance.
That's a good term for you guys to know. PITI. Principal, interest, taxes, and insurance.
Divided by your gross
divided
income
by your
W-2.
gross income W-2 net
Got
if you're self-employed. Okay, so you asked me about the ratios,
Got it.
and we're speaking about PITI.
Yes.
So let me just, and this is great that Roger brought that up because this is really important. PITI, right? And principal, interest, taxes, and insurance. And the insurance, FYI, is not just homeowners insurance, which protects the home, right? You have to have that. You want to have that to protect your home. But it's also mortgage insurance. So PITI, that's an important acronym for you guys to keep in your mind when you're looking for a home. Okay, so now Roger brought up a front end ratio. What's the front end ratio? It's the PITI divided by your gross income if you're W-2, or the net income with the add backs and so on and so forth if you're self-employed. So on a FHA loan, the front end can go up as high as 46.99.
Got it.
On a conventional, typically you don't want to go. You want to stay below 45. Now I've taken it, and it can go up to 49.
On
Conventional, but it depends on the scenario.
Got it.
It depends on the scenario. On the back end, now what's the back end? The back end is the mortgage payment plus the minimum monthly payments on your credit report, and then if you have child support or that you make payments on, that gets included in your debt. So you take your payment, your PITI, plus that credit debt, add that together. We call that your back end ratio, and we divide that
by the income.
Right. Now, on an FHA loan,
so that's got to be higher. I mean, the ratio's got to
yes.
be higher.
Now, here's the beautiful thing. On an FHA loan, we like to keep it below 50.
Oh, I see.
But we can take it up to 56.9.
Oh my God.
Yes.
So now I see clearly what the pros of the FHA
huge,
are. So
huge.
you have a lower credit, you have more debt, and you can still go ahead and
Yes,
buy
sir.
property.
Yes, sir.
I got you. So
And it's incredible because I've had people, and I've had like Wall Street guys who make $300,000 a year buy an FHA home.
Do they spend a lot of money?
3.5% down. They wanted to use the bank's money. Yes, could they afford it to come out of pocket to pay 20%
Why
down?
do they have to?
But they said, hey, I'm going to put down 3.5%.
Money makes money.
Exactly.
Got it.
Exactly.
Got it.
And they bought like a multifamily home for 3.5% down. $600,000-$800,000 purchase.
So FHA can go up to 56 in some cases.
56,
and what
maybe.
about the conventional?
Conventional, I have seen a tad over 50. A tad over 50 on the back end. But typically on conventional, you want to stay below 45.
So why would anybody go for conventional versus FHA?
Oh, well, we spoke about the mortgage insurance before, right? That mortgage insurance is a killer.
So there's no mortgage insurance on
No, there's
conventional?
good. Okay, it's a good point. So there is mortgage insurance on a conventional loan, but on a conventional loan, it can be canceled. Okay, it goes away. Right?
Got it.
So
in the FHA, you have to wait 10 years.
No, FHA is for the life of the loan.
But if you put 10%.
If you put down 10% or more, then after the 11th year, it will go away.
So you have to hold the loan for 11 years in order to get out.
You don't have to hold it.
I mean, you can refinance it, but...
And that's the thing I tell my clients, by the way. So if you use an FHA loan, use it to get into the house.
Makes sense.
And then after...
Improve your credit, lower your debt.
Exactly. And then after perhaps depending upon how much you put down and depending upon how the value of the home increases, right? That spread.
Right.
By the way, here's an important concept. Very important. The spread between the value of your home and the principal that you owe, we call it equity, right? That's called equity. So when you have 20% equity or more in the
The
property,
mortgage insurance is gone.
well, for a conventional, you have to request an appraisal. It has to appraise for that value, and then if it's 20% equity, it goes away. If you don't, and you
Not in the FHA, only in the conventional.
right, see that's the
Crazy.
thing. FHA, you want to refinance out within perhaps, it depends, but I'm going to say rule of thumb somewhere between 4 to 6 years. Refinance out of the FHA loan, get yourself into a conventional loan, and then you get rid of that mortgage insurance.
So, who's the ideal buyer for conventional?
Again,
So you said credit score 620.
someone with at least, now remember this, this is very important. Credit score is directly correlated and tied into your interest rate, right? Better credit, better interest. Why?
Ah.
Because the banks see you as someone who's more
Reliable.
You've earned it.
Yeah.
You've earned it. You've done the work. You've kept your credit clean. You should get a better interest rate,
Obviously,
right?
you less risk.
And less risk. Exactly. So what we're looking for, right? So on a conventional loan, someone who's got better than average credit, right? Someone who can put down. I mean, listen, you can put down a little 3%. A little as 3% on conventional if you're a first-time home buyer. We have something called Home Possible and Home Ready, wonderful loans. And then Sonny Mae will get into, but so it's little. You can put a little bit of a down payment, and the mortgage insurance goes away. You can get that mortgage insurance.
Once you build an equity of 20%.
Right, and here's the big thing, right? You got to take into consideration if you do an FHA loan to get rid of that mortgage insurance before 11 years. If you're putting down 10%, you've got to refinance. Refinancing is another fee, right? You got closing costs, right? Don't forget, everybody. You got closing when you buy a
So
home.
it's usually ideal for the people who are looking to hold on to the property for a long term.
Correct.
You roll the closing costs back into the loan amount.
That you can do in a refinance. That's important, what Roger just said. So when you refinance, you can roll the closing costs into the loan on a refinance.
And depends on the interest rate. If the interest rates are as low as these days,
Correct.
it probably makes sense for a lot of people to refinance.
Absolutely. I'm doing a lot
If
of
they're thinking of staying in the property long term.
Yes, and there's one other reason. Cash out refi. So if people, right, I got a lot of people who have equity in their home. Remember the concept of equity? We got the value of the home minus the principal that you owe on your mortgage, right? If you have a mortgage. If you don't have a mortgage, you got 100% equity. So what a lot of people do, now here's how you're going to get to be a wealthy person if you're not already. So you take money out of your home, right?
Take the equity.
Take the equity, a chunk of the equity.
That's why they call it cash out, because you
Exactly.
take cash out of the property.
Exactly.
But the question is, what do you do with the cash? I mean,
What do you do with it? What do you?
You're gonna buy
you
a
guys,
buy a new car,
if you're
vacation.
thinking business person and entrepreneur, you're not thinking vacation buying a car. Although that's a good thing to do, but roll it into another purchase. Call up Roger. Tell him you need another house.
Not investment property.
Call me up. Tell me you need a mortgage. But what you want to do is, right. What you're doing is you're going to take money out and you're going to parlay that into your next purchase. Right. You're going to use that money as for down payment to your next purchase, and this is how people build wealth in real estate.
That's right.
Right. This is the way
Especially
to
in a
do
market
it.
like in New York City, when there's a really great appreciation and the rents are always rising.
Absolutely.
Makes sense.
Absolutely.
So I think that wraps up the conventional financing. Let's talk about stated income.
Okay.
Very popular here in New York City. I'm sure it's
Yes, indeed.
popular in other parts of the country as well. We've done tons of those stated incomes. Pros, cons, ideal buyer.
All right. So here's the stated income. We call it light doc. I call it a light doc loan. Okay. Why?
Very light.
Because, stated income loans years ago crashed the market, right? I mean, people just made up how much they made, right? So right now we have a loan program, and I have a loan program. There are a few banks that do it. There's not a lot of people that do it, but how it works is like Doc stated. So you basically, number one, the ideal candidate is someone who's self-employed for at least 2 years.
Business owner.
Business owner, at least 2 years in the same industry or the same job capacity. Okay, and
so it's got to make sense.
It's got to make sense. Right.
Can it be a restaurant versus an Uber driver?
That is correct. Right. We wouldn't take that. So
but we can do an Uber driver.
You can do an Uber driver.
A limo driver.
Yes, exactly. Okay. Very good point. Very good point. So at least 2 years. And how do we confirm that? We get a letter from a CPA that says you've been in that industry, self-employed, for at least 2 years. Okay, that's number one. Number two, we get a self-prepared P&L, profit and loss statement.
By the accountant?
No. Actually, here's an amazing thing. You, the borrower, do your own P&L.
Got it.
So we take that, and that P&L, if that P&L shows us in the bank that you make enough money, and here's where it's sort of stated, right? Because you're stating it yourself.
That's where they got it.
Right? So you're stating it yourself. You get a letter from the CPA that says you've been self-employed in that industry for at least 2 years. You have decent credit. You got to have decent credit on this program.
What's a decent credit?
Well,
stated income.
Ideally,
I think it's in 700s if I remember.
Yes, 7. I can do below 7. But you want to really be right around starting at 7 because you're going to get a better, more favorable interest rate.
If I remember correctly, I remember you got to have a good down payment. You gotta put some skin in the game.
Okay,
this, right?
So listen to this. This is pretty amazing. This is really pretty, and this just changed recently. It used to be 25% for a single family, 25% down.
As a primary residence, I want to live in the property.
Primary.
Got it.
Primary.
Is it for income producing properties as well? Can I buy investment property with stated income or not?
Yes, you can.
Oh, I can. Okay.
Yes, you can. So on a primary property, and I think investment as well. I apologize, I don't know off the top of my head, but you can put down as little as 20%. It's amazing.
Wow.
20% down, tax.
I remember it used to be like 30% down payment.
Well, we were doing. That's right. So
remember back in the day, it was like 30% down.
That's correct. They the program that I have access to allows you to put down as little as 20%. It's crazy. So think about this.
What's the catch?
No tax return, no W-2s, no 1099s, no pay stubs. Okay, a self-prepared P&L.
What's the catch then?
Here's the catch. Interest rate is not as good as a conventional and FHA.
So it's a much higher interest
rate.
Right.
So I don't want to say much higher because you're probably looking at, with decent credit, you're probably looking at a high 5s to low 6s. And on a 30-year fix.
And regular conventional loan?
Regular conventional, I'm doing these days in the low 4s. I'm even going down into the 3s, high 3s.
So big difference.
So
high 3s, low 4s on a regular financing when you prove your income, when you show your W-2s.
Yes, sir.
If you're not willing to, there's an availability in the market, but the rate's going to be in low 5s, mid 5s.
And you know what?
And you got to put more money down.
And rightfully so.
Yeah.
Because look,
makes sense.
You don't have to show me tax returns or pay stubs. Again, it's a useful program for those that are in that,
So to recap the stated, the pros, business owners, you don't have to show tax returns, but cons, the interest rate's going to be higher. Mm-hmm. And you have to put more money down.
Right. Now, I also just want to say, quick note, it can be used for W-2 employees. We can also do it for W-2 employees. But
why would they do that if the rate is so high?
Well, how we verify income on that is we go to your employer and your employer fills out a verification of employment form.
VOE.
A VOE. So still, again, no tax returns, no W-2s, no pay stubs.
Still stated.
It's still sort of stated, but it's stated by your employer.
Gotcha.
Right?
So it's much more flexible, though. It looks like much more flexible type of a loan, but it's going to cost you more money.
Yeah.
The interest rate's going to be higher.
Yeah.
And you need more money down. There's no question asked.
Correct. Okay, so the stated program is really best for someone who doesn't want to show income. Right? Either doesn't want to or can't. right? So no tax returns, no pay stubs, no W-2s, no 1099s.
Those are huge advantages.
Huge advantages, and you can put and you have good to great credit, and you can put down at least 20% on a one family, 25% or more on a multifamily.
Got it. And the cons, higher interest rates.
Cons, higher interest
And
rate.
you gotta put more money down.
And you gotta put
more skin in the game.
But here's the other thing, just quick note. You get into the house with a higher interest rate, and then
Same thing.
if you do your tax returns down the road, or you show more income, then you refinance.
Understood.
And you get yourself, and you can pull money out as well.
So it's just maybe good to get into the property and eventually
Yes.
exit with the refi.
Correct.
Got it. Understood. So stated income covered. Let's talk about our favorite, Sonny Mae.
Sonny Mae.
Go for it.
Amazing, amazing program. State of New York Mortgage Agency. Okay?
State
SON
of New York Mortgage Agency. Got it.
Yeah.
So they look.
So yes, it's New York State, right?
Mm.
So give me 1 second.
Is it
Okay.
first time home buyers only or is it investors as well?
Yes. Well, mostly first-time home buyers, but you can be a second-time home. You can own.
Is it again the 100-mile?
No, for Sony Mae, it's a little different. So they have areas that they call target and non-targeted areas. Okay, a target area is a target of Sony Mae. What's a target of Sony Mae? A target of Sony Mae is an area that they want to build up, right? So they want people
So
to
they have
buy
like
into.
they collect a census and they look at.
Exactly,
Got it.
exactly. So if it's a target area, Sony Mae will allow someone to purchase a property as a second property.
So you do have a mortgage, you do own a property as a primary.
Correct.
And you look at you buy an investment property, it has to be in
Well,
the target
actually,
area.
it's not. And forgive me, please forgive me, and I'll get back to you somehow. But I think Sony Mae can only be for primary properties.
That's what I thought. That's what I asked.
Oh, okay, yes, for primary, but you can be you can own a property. You can own a property, but you can use a Sony Mae loan in a targeted area to buy another primary that you're moving into.
Understood.
Yeah, it's got to.
Understood.
When I say yeah.
Let's talk about the pros. Who the ideal buyer for the Sonny Mae was, and why do we like it so much?
Okay, so Sony Mae, really amazing program, and it's typically, as I say, and we're saying, for first-time home buyers. Okay. And it's a little more conservative on their income, right? So that we were talking about ratios before. On the front end ratio, it's 40, a hard 40.
Oh my God.
Yeah, right. So you got to make more
The
income.
FHA was, if I remember correctly,
46.9.
47. The convention was a little lower, right? 45.
No, conventional typically 45, but I have gone up to 49.
And the Sonny Mae, it's
40.
wow.
So that's that's
So basically, in other words, you've got to have good income and no debt in order to qualify. I mean, hit that number. You got to have a better income versus your debt.
that is correct.
Right.
That's correct. So 40 on the front, 45 on the back. 45 on the back. Okay. So yes, it's a program designed for low to moderate income people and areas, typically. Okay. So and they also, they're not, and this is the interesting thing about Sony Mae. Their credit scores are not tied to the interest rate.
That's a good thing.
It's amazing.
Yeah.
But they want to see good credit. What's a good credit? What's good credit?
To them.
To them, things that don't have a lot of negatives.
Understood.
Recent negatives.
Late payments.
Late payments, judgments, liens. And they also want to see that you've had at least 3 trade lines and what's a trade line? Trade line is like a credit card or a car or an installment loan, right? We call these trade lines, or
something they can basically
month to month watch your payment history, right? So you have to have 3 open trade lines for 18 months.
Got it.
3 open trade lines for 18 months, right? And there are exceptions. Sony Mae is really cool in many regards, for exceptions based upon the scenario, right? Based upon the scenario. So it's a little more income restrictive, debt to income ratio restrictive. They are looking for decent credit, right? No blemishes. Now here's the kicker. Here's why this program is so amazing.
That's why we're pushing it all the time, if we can.
Here's why this program is so amazing. Because they give something called DPAL, down payment assistance loan. What is this thing? This amazing thing. And there's other things I'm going to tell you about in a minute as well.
I don't call it this fancy word. I call it free money. Take it if you can.
It's sort of, yes, free money. But there's a little catch, which I'm going to tell you the catch. So down payment assistance loan, Sonny Mae will give you up to and including $15,000 back towards your closing costs or your down payment.
That's a lot of
Okay,
money.
it's a lot of money, right? Very, very helpful. What is this? Is it free money? Sort of. It's a loan at 0% interest. Okay, it is not included in your mortgage. It's a loan that Sonny Mae is giving you that they say if you stay in the home and the mortgage for 10 years, you don't have to pay anything back. It's yours for free. If you get out of the home or the mortgage within 10 years, you have to pay back a prorated portion for the time that you didn't stay in the home or mortgage.
Understood.
Okay, so it's
still free money, but you're not gonna get maybe all 15,000. If you get out earlier, you might have to return some of the money back.
That is correct. That is correct.
Got it.
But it's amazing, right? Mm-hmm. So if you buy a home that's $500,000 or more, you can get the $15,000. If it's less,
that's why we like this program so much. I mean, we've had deals this year.
Amazing.
That basically helped the buyer to get on the property.
Yep.
They were short on the money. They didn't have enough money down, or they were short on the closing costs. We introduced this. I call it free money, deep power, and it actually.
I'm not allowed to say that.
I am, but it made the deal happen. So it's amazing.
Yeah.
What about
let's
the
talk
20?
The 20. So right. So
there's more.
So by the way, so if your home purchase is $500,000 or more, you get $15,000. If it's less than $500,000, up to 3% of the purchase price. So here's the other thing. NRP, Neighborhood Revitalization Program. Really, really awesome. So Sonny Mae will give an additional $20,000, as Roger says, free money, which again goes under the same ruling of the 10-year ruling. Free money, which can be used for renovating the home. A new kitchen, a new bathroom, new flooring. And there's a whole list of things that you can use it for, right? So it's basically money. They're not giving you the money, but they're giving you access to the money to get a contractor to do the work, up to $20,000 to do renovation work to the home.
It's amazing. So you buy a property, you get $15,000 towards your down payment if it's over $500,000.
Yep.
And then if the property needs work, you can ask for another grant of $20,000 that you can use to renovate the
That's
home.
$35,000.
Right there.
Now, to get the NRP money, the house has to be vacant.
At the time of?
Typically, I will say, the house has to be vacant at the time of the appraisal. Okay? The logic is, Sonny Mae saying, you're buying a house that's vacant. They call it a zombie house. It's sort of like been sitting there, right?
You need $20,000 to renovate.
And you need some money to renovate.
Makes sense.
That's it.
Makes sense.
Right?
So if it's occupied by the owner or by the tenant
Yeah.
at the time of the appraisal, then unfortunately you probably won't get the $20,000.
Unfortunately, yes.
Got it.
So then there's a third part of the Sonny Mae program that takes it even to another level. So if you need more than the $20,000, or you can't qualify for the $20,000 because somebody's living in the house, the seller's living in the house, Sonny Mae will give you renovation money. Remodel New York. It's a wonderful program. Remodel New York. By the way,
That's
NRP,
easy to remember. Remodel New York.
Remodel New York. NRP is under the Remodel New York umbrella,
Understood.
but Remodel New York is where they'll give you renovation money if you qualify.
But then you got to pay for this.
But you got to pay for it because it's rolled into your loan.
So do they merge it into like a one loan? Is that what it is?
Yes, it is. Exactly right. So you're you know what? I think it's one loan. I'm not sure, but
it should be. Usually it is.
You know what it is? My mistake. Yeah. It is. It's one loan. So if you're doing Remodel New York and you're taking that extra money, or $20,000 or $30,000 or whatever, because you want to do whatever you want to,
it needs more work. The house
needs more work.
Yeah.
It gets rolled into the loan.
And you don't have enough funds on your own. You can get the money from the bank, roll into one loan, and
correct.
And build the property up and increase the equity right away. Got it.
It's real. I tell you something. I've had borrowers, and I think you were there, Roger. that like hugged me. You know, they were like,
I hug you too for 35. It's a lot of money.
It is. It's really, thank you, Sony May. You're really making a difference in, so many people's lives.
You're building in New York.
Really, really building New York. I got to throw two things that Sony May has as well. They have an FHA plus loan and a conventional plus loan. Okay?
Meaning, explain.
Meaning, you can take the FHA that I described earlier, and Sony May will give you 3% of the purchase price towards your DPAL, your down payment assistance
Or
loan.
$15,000 cap.
Okay.
Because what if you buy that $100,000 property? 3% is 27 grand.
I was told, and I still am in a little disbelief, and I apologize. I'm not 100%.
That's okay.
But I was told.
We can find out though.
We're going to find out. I was told that there is no cap on the 3%. There's no cap on the 3%.
And same rule applies. 10 years.
Same would apply for the DPAL. It's the 10 years. That's right.
That's amazing.
So it's amazing. And that goes for an they call it FHA plus and conventional plus. And it's just it's the DPAL adding to the FHA.
Where are they getting the money from? Is it from the state?
It's the state.
It's the state of New York.
State of New York has this money and they're giving it to
first-time home buyers.
First-time home buyers.
Properties.
Exactly.
Keep the economy going.
Exactly.
Makes sense. So I think that pretty much wraps up the state. That's our absolute favor. So
Sonny May.
Sonny May. I'm sorry. Sonny May. So that's our absolute favor, right? When we get a first-time home buyer, we always first trying to see, can we make this happen?
If they fit into that program.
If they fit in the 41.
Yeah.
You said 40%,
40,
right?
45.
40-45%
Yeah.
debt income ratio. Perfect. The last one we need to discuss, it's going to be, we got two more. So 1-year tax return program. Very popular.
Okay.
We've done it many times.
Yeah.
A lot of people love it.
Yeah.
Tell us about it. Pros, cons, ideal buyer.
Typically, we do a 1-year tax return program for folks who have been self-employed for 5 or more years in the same corporation, in the same LLC, or in the same industry.
So 5 years.
5 years.
Minimum.
Got
it.
In the same industry, job, corporation, LLC. So you
can be a self-employed as well.
You've
got to have 5-year
history. You've got to have a 5-year history. So
it's got to be the one corporation.
Exactly.
You can have one and then you open up another one.
Correct.
It's not going to work.
Not going to work.
Gotcha.
Not going to work.
Gotcha.
Yeah.
So it's not for everybody. That's a con.
Not for everybody.
Not for everybody.
But it is wonderful because if you have been in the same industry for 5+ years or the same entity as we just said, then you can show us 1-year tax return and qualify for a mortgage. Now, there's a little caveat on that. If I run your scenario through my computer system, sometimes you can have less than 5 years and it will give you an approval on 1 year. But that I don't know that that's got to go through a computer system.
Understood. That's up to you.
Yeah.
Perfect. So who would be ideal for?
Well, ideal would be for someone who's
whether maybe a down year, didn't have a really strong year,
correct.
Came back with a really good year,
right?
And now still 12. Because usually you need 2 years.
That is correct. I was just going to say that.
2 years, right?
Yeah.
But if you're self-employed and have a good year, you travel, business was not as good as always. Now you had a good year, you can still go ahead and
that is correct. That is correct. Because as Roger says,
so we do it a lot. We do those a lot.
We do that a lot.
Yeah.
What you do is on a self-employed person, you're averaging. If the income was increasing, you're averaging the last 2 years. If the income is decreasing from the prior year to the current year, right? If the income's decreasing, then we're going to use the current year. Why? What's the logic of that? Because, you were going downhill, and so we got to be more conservative. We don't know why you went down, but so that's...
Makes sense. So that's 1 year tax return program.
Yeah.
Great program out there. We're going to wrap up.
And that's a conventional loan, by the way. So it's, you still get a favorable interest rate.
And same rule applies with the debt to income ratio and with the mortgage interest, right?
Yeah.
Perfect. Let's wrap up with the hard money.
Okay.
We don't like those.
But it has its use. It has its use.
If you're purchasing a property that's at really discount and you need to close tomorrow and you just can't get a regular financing, it's the way to go. We've done it a couple of times when the borrower / buyer actually benefited because he ended up purchasing something at a really good price.
Correct.
Explain
Correct.
how the hard money works.
So typically hard money, and why do they call it hard money? Because it's like hard cash, right? It's really someone, it's not a bank. It's usually like a group
Private
of individual,
investor,
private
private
investor who's got a bunch of money and they're willing to give you.
That's why they call them loan sharks.
Yeah, loan
Right.
So they're willing to give you a chunk of money. You want to buy $1 million home. Now, typically, you got to put down at least, I think, 25% on these.
So you gotta have skin in the game.
You got to have at least, you got to have skin in the game. And I believe it's at least 25% they're looking for, a hard money lender. And why? Because they're going to give you, let's say it's $1 million home, they're going to give you $750,000 in cash. And it's going to close quickly, right? Because you need to close
What's quickly?
1
week, 2 weeks?
1 or 2 weeks.
1 or 2 weeks.
1 to 2 weeks, yeah. They, typically.
Especially when I see these scenarios, is sorry to interrupt, right? When there's a foreclosure and you're buying something 60 cents on a dollar, you're getting an incredible discount, right?
Correct.
And you have no other option because you need to close like now.
Yep.
And the regular financing is about 60 days, right?
30 to 60.
Yeah, then you just go ahead and you use these hard money lenders.
Yeah.
You close on the transaction, and then again, you refinance yourself.
Exactly right. Exactly right. So these hard money lenders, they know you're not going to qualify for a regular loan, or you need the money fast. You need the money fast. So they're going to hit you with a 9, 10, 11, 12% interest rate. Yes, sir. 9, 10, 11, 12. And they're going to hit you with what's called points. This is a cost, right? Like 2 points of the loan amount.
So you said $750,000 loan amount, 2%.
2 points, that's $15,000 is their fee.
Wow.
Plus they hit you with a high interest rate, right? And it's normally for somewhere between like 6 to 12 months. It's fast. It's a fast loan. It's to get you the property quickly, and you got to get out quickly. So you got to have an exit strategy, right? A hard money lender will always ask. They'll say, "Okay, Pete,
is there a minimum you have to stay with them, or can you just get out right away?"
No, well, it depends. So actually, it's interesting. So some hard money lenders will tell you, you got to stay with me for at least 3 months. I want to make my interest. I want to make my interest for at least 3 months. If you get out, no problem. But I'm going to penalize you for that.
Understood.
Right? Because they want to make their money. That's how they make their money. Now, then you've got to have an exit strategy, and they want to know your exit strategy because they typically don't want to take over your home. They don't want to foreclose upon you, right? They're in it to make money.
Yeah, they want to just keep rolling the money.
Exactly. So they want to make sure that you have an exit strategy. You're gonna do your tax returns next year, or you just needed quickly to get in a loan, but you just couldn't get a regular loan because you didn't have enough time. So that's what a hard money lender is.
So ideal for someone who's got an opportunity to buy something at discount.
Right. And by the way, hard money lenders typically 99% of the time will not allow you to buy the home as a primary property. Typically, they will not.
Wow.
And they want you to buy in an entity, an LLC or corporation. Why don't they want you to buy as a primary?
Protect themselves.
What's that?
They want to protect themselves.
Exactly. Because if they need to take over the home, if they need to get the home back, they want to, they don't want to. Again, they don't want to, but they want to know it's not your primary, because if you're living in the home, it's much more difficult to take somebody out.
Got it. Guys, I know we went super fast, right? We covered the FHA, the conventional, stated, Sonny Mae, one-year tax no problem, hard money.
Yep.
If you've got more questions, and like what we do with Peter, the most important thing to us is always pre-purchase consultation. First initial meeting.
PPCs. He invented that term.
I invented it. PPC, pre-purchase consultation, right? Because if we sit with you as a buyer, we need to first understand your affordability. We need to understand what you're trying to accomplish. Where do you want to be? So we'll discuss all these options. If you have more questions about all these types of financing, we'll leave in the comments information for Peter, so you can reach out to him anytime, because
so much.
We could go all day about this topic. Now, also I created another video actually regarding the affordability, how to actually in less than 10 minutes you can calculate your own monthly payment. You can look it down here, you can watch that video. And as always, thank you very much for tuning in. If you're looking for real estate related content, value, please check us out next week. Take care now. Bye.
Thank you.